Hey guys, let's start with a quick summary. I will talk about a couple of things in this video. One of them being how the bank is stealing money from you when you invest in mutual funds. I'm going to show you the difference between various funds, not just in terms of definitions, but also with respect to the amount of money you lose if you invest in the wrong fund. And by the end of this video, it will be obvious which those are. I'll show you the results of the math so you can judge for yourself. Here are a couple of funds I will go through, but I will focus on index and ETFs. Then I'm going to show you a tool that I use to compare funds. By the way, did you know that in any fund, only 80% of its constituents needs to match the description of the fund? For the other 20%, managers may use derivatives to make all sorts of risky bets. I will then show you how you can avoid all fees and make your own fund that tracks the fund that you want to buy. I also have some insider information on how Wall Street fools money managers and profits off of them. And finally, you guys are going to see what I have in one of my retirement accounts and how I pick ETFs and indices for it. Now make sure to subscribe if you're serious about investing successfully. And let's hit it. Don't you hate it when people tell you what to invest in without showing you why? I see this all over YouTube. Everybody is an expert these days, a self-proclaimed expert. On this channel, I try to show you why, and it usually comes down to math. If you're new here, welcome. My name is Adrian, and I'm an engineer, and I used to work in finance for a market maker, specifically in algo trading. I have a couple portfolios that I manage. Some are based on indices, some are equities, some are bonds, some are mutual funds, some are derivatives, and I also manage the accounts for my entire family. But now let's get back to the video. Did you know you could have almost $1 million extra on average when you retire? You're paying and the bank is not even sending you a bill. Before we get more into it, let's look at a couple of charts, see where that number came from. The reason for this is a secret fee common to all mutual funds. The yellow line is the average fee, which comes to about $900,000, almost $1 million, but your account could fall anywhere in that shaded area, so the most you could be paying is almost
$2 million.
Before I show you how to lower that fee down to zero or very close to it, let's talk about the different funds you might find yourself investing in. If you're a beginner when it comes to investing, there is so much information out there. It can be overwhelming. To give you an example, I will list the types of funds that are available. Mutual funds, index funds, closed-end funds, open-end funds, load funds, target date funds, exchange trade funds. And that's just the funds. You could trade different parts of the yield curve, derivatives, swaps, options, futures, commodities. The list goes on. If every year you tell yourself that this is the year when you figure it out, I think you've come to the right place. I'm going to try to speed up this process for you. First, let's talk about what a fund is and what its characteristics are. Because in my non-expert opinion, if you're a beginner, you have to start with funds.
Why should I stick to funds?
The short answer is capital protection. The long answer is funds invest in a collection of stocks. So if a few of those companies go bankrupt, meaning that their stocks go to zero, the fund itself is not going to zero because it has other constituents. The fund will go to zero and lose all of its value only when all of its constituents go to zero, which means that all the companies would have to fail at the same time, which is pretty improbable, but it could happen if we get a meteor crash. Not only that, but shares are weighted in some way. For some funds, each constituent is an equal percentage, but for others, they're market cap weighted.
Don't speak words I don't understand.
Let me finish. If a company is worth more, the index owns more of that company's stock. But before I talk about funds, let's understand what an index is. An index is a collection of investments, and just like funds, each constituent is set to a percentage of the fund. Some examples that you may be familiar with are the NASDAQ 100, S&P 500, the Dow Jones. These are just for US equities, but you can have international, you can have gold, bonds, oil and gas, and so on. Now, a mutual fund's money is allocated by a money manager to various financial instruments. All funds have something called a NAV, which stands for net asset value, and it's calculated as assets minus liabilities divided by total shares. So this NAV represents the per share price of the fund. So just like stocks have share prices, mutual funds have NAVs. But funds also have something you don't want, called MER, or management expense ratio. Sometimes I call it MER, and it's expressed as a percentage. The lower the better. All funds provide a figure called total return. This consists of the fund's distributions to shareholders, plus or minus any change in the fund's NAV during that period of time. So for a calendar year, the distributions were 2%, and the fund's NAV appreciated by 4%, the fund's total return would be 6%. Some funds also offer a yield. You can think of this as interest being paid to you for investing in the fund. I'll make another video to explain the various types of yields out there. There are funds specifically created with high yields in mind. But if the yield is too high, it means the fund's holdings are very risky. And in order to attract investors, the underlying instruments of the fund are willing to pay big money as interest to you in order to get you to put your money in. An example of this type of fund is the junk bond, ticker JNK or HYG. So there are good funds and then there are bad funds. Funds in turn can be closed-end, open-end, actively or passively managed, and have a higher minimum purchase amount. Let me explain the types of funds you can find and which ones are good and which ones are better. Let's start with index funds, which are passively managed funds. An index fund is a mutual fund that tracks an index, basically tries to approximate the holdings of the index. As a result, it doesn't require much active management, which brings down its management fee, as you may have guessed. These have lower MERs, under 0.11%. Actively managed funds, on the other hand, try to beat indices and thus require more active management, as the fund manager is using his knowledge of the industry to pick better stocks and get higher returns than an index. Or so they'd have you believe. However, there have been several studies that show that you can get better returns if you stick to indices instead of mutual funds. It has been shown that if you pick stocks at random, you actually beat money managers on average over a long period of time. Here's a summary of one of those studies. It was made by someone at MIT, and it shows how much better equity mutual funds are compared to indices. That's what this alpha means. The average is below 0, and 0 is where the index fund is, so that means that most active funds are not beating the index. I'm not sure if this distribution accounts for survivorship bias or... By the way, survivorship bias means that you don't hear about funds that failed and no longer exist, and as a result, they're not included in any research, which makes it seem that more funds do better than in reality. Warren Buffett, this guy, maybe you've heard of him. He made a bet some 20 years ago that a passive S&P index would beat a bunch of hedge funds. And it just happened that he won. And I think he won in 2015. Now think about it. If the fund manager trades actively, that means you can never really know what's in the fund. There's less transparency because you have to wait a couple of months to look at the holdings. And by the time, they probably change anyway. You have to trust the money manager that he knows what he's doing. And get this. The fund's performance is not tied to the management expense ratio. So that means, in other words, the manager can do a poor job at picking stocks for you and he still gets paid. Would you trust someone like that with your money? Me neither.
Yeah, but he's so much smarter than me, and he's wearing a suit.
I just said that over a long period of time, on average, indices beat active funds. And you just saw the distribution of returns.
Myth busted.
Let me elaborate on this a bit. An index fund is the market, and actively managed funds try to beat the market. But by trading, they themselves are part of the market, so they move the market when they buy or sell. Some perform better, and some perform worse than the market. If you were to take the average of their performance, you would get the market. But the market is tracked by the index, so we can say that the index is the market. Do you see the problem here? There's no way all active fund managers can beat the market because together they are the market. There's a book that expands on this called A Random Walk Down Wall Street. You can go read it if you want. I'll link it below in the description so you can take a look. But the part that I'm talking about is that if you have monkeys pick a list of stocks, they will do better than money managers on average.
Where can I get monkeys like that?
This guy. At this point, you might ask, why would anyone invest in active funds? And that's because not everyone is educated. I'm doing my part to change that, one viewer at a time. When my parents went to their accountant to help them with their retirement account, that accountant sent them to a broker who gave them the highest fee mutual funds I've ever seen, something like 2.7%, and then they had to fight with him just to get another fund which had an MER of 2.4%. Still really high. So I said forget him, and that's how I came to manage their accounts. Speaking of taxes, from a tax perspective, an index fund is much better. Since a mutual funds manager trades actively, this will result in multiple taxable gains for you. Anything that's passive can be held in a regular account without having to pay a lot of tax on the gains. Let me tell you a less known secret about Wall Street and fund managers. It's well known when funds receive new money, because in the middle of the month and at the end of the month, people get salaries. And as a result, they take a part of that money and deposit it in several funds with money managers. This is exploited by Wall Street by front-running the money managers. In plain English, this means that they're going to buy before the money managers are able to buy, and then a couple of hours or days later, Wall Street is going to sell back to money managers at higher prices. Now, some money managers have caught on to this, and they try to stay ahead of the curve and ahead of Wall Street, but not all of them. And not all of them even care, because remember what I said about fund managers. They get paid regardless of how their investments do. This guy, he knows something. I'm not going to talk about open-end funds because unless you've got connections, you're not going to be able to get into them. I've only been able to get into one of these funds, a debt-related fund for real estate. Another type of fund that I will be discussing is a closed-end fund, or CEF. It has a fixed number of shares, and once the fund is created, the investor trades ownership of shares in the fund, in the same way as stock is traded. What I like about closed-end funds is that there are situations when you can buy well under a fund's NAV and then sell it when the fund comes back to NAV or above and book a profit. Target date funds, or TDFs, also fall under the actively managed fund category. I just want to mention these briefly. Basically, you pick a target date for your retirement, and the fund will rebalance your portfolio automatically. As you get closer to retirement, as you get older, the skew will be more towards bonds because they're considered safer than equities, but that is until the government defaults. Leverage funds, stay away from them. Actually, stay away from anything leveraged. Maybe I should mention ETNs in here as well. Those are exchange-traded notes. Not that it matters. We don't care about definitions so much. But there are also something called triple leverage funds. You can even go to 9 times leverage. All these leverage funds exhibit tracking error. So unless you know how they work, or you're looking for day trades or maybe weekly trades, I think you should stay away from them. By the way, if you have a lot of cash, Fidelity and Vanguard offer no load funds and even lower cost funds. These are the Vanguard Admiral funds, Rogue Price Summit funds, and Fidelity Spartan funds. Now there are also exchange-traded funds, or in short, ETFs. These are traded throughout the day, just like stocks, instead of only at the end of the day, like a mutual fund. Being funds, they also hold a collection of instruments, stocks, bonds, and so on. The cool thing about ETFs is that they can trade commission-free on most brokerages, have lower MERs, and they have no minimums. You can buy 1 share. They're also better from a tax perspective than actively managed funds. Well, at least most of them. There are ETFs that are actively managed. Most of them are passively managed. You just buy it in a brokerage account. On top of higher fees, what I dislike about non-ETFs is that you can never have a GTC order. Instead, you just give the money to the fund manager and they buy whenever they feel like, whatever they want. By the way, a GTC order is an order that you place in your brokerage account specifying at what price and what amount of shares you want to buy of a particular fund, in this case an ETF. The important part is that you set both the price and the amount. The order will wait until the market reaches it and then execute, and then you end up with the shares. So many options, how do you know which ones to pick? Overall, ETFs have the smallest fees, then index funds, then the rest of mutual funds. But there are many funds to choose from, so you have to decide for yourself if the complexity of the product will be advantageous to you. Here are a few questions you might want to go through. Do you want to purchase a taxable fund or one that is exempt from federal, state, and local taxes? Is the fund's purpose to maximize return or minimize risk, or both, or neither? What is the historical risk-reward return when you invest in that fund? What is the best investment vehicle for investing in the fund you selected? What is the track record of the fund you selected? How long has the fund manager been with the fund? Is he leaving now? If you are subject to the AMT rules, check out whether the fund buys instruments subject to the AMT. I would say don't own any funds in a non-tax advantage account, unless your index funds are very passive ETFs. This is because you'll pay more in tax. So keep those for your retirement accounts only.
Why do you care about the MER? It's so small anyway.
Well, let me show you why. Those small fees really do add up. I think the bank wants you to think that way. Such a small fee, ignore it. The part I dislike is that you never get sent home a bill. The MER is quietly taken out, so you might have not even known about it until now. Let's look at some charts now and see how much of a difference that small MER fee makes in a portfolio when you invest $10,000 every year for 10, 20, and 30 years. The underlying assumption that I made here is that the market grows on average 7% a year, and you don't take this money out. The blue line is your balance if you invest in an index fund. The red line is a balance if you invest in an actively managed fund. The yellow line shows the difference between the red and the blue line, and it represents how much more you'd be paying in fees if you use an actively managed mutual fund. Notice that after 10 years, you pay extra $8K in fees. After 20 years, almost $50K. And after 30 years, it's $175K. I don't know about you, but I like to keep that money. So not only does the manager of an active fund need to beat the index by at least the MER for you to break even, but also this has to be done consistently over 10, 20, and 30 years period. That's a long time. If you know of another Warren Buffett, let me know. Just put it down in the comments
below.
Now what if you invest 30K a year instead of 10? The difference is 25,000. In 20 years, 150,000. And after 30 years, over $500,000 that you paid in fees. Your bank will love you. I will show you a few more of these charts for various amounts that you put in to give you an idea what returns to expect to on average over a long period of time. Now if you think all of these charts look the same, just make sure to look at the y-axis. You might be surprised. A 50K deposit every year will get you at the end of 30 years a fee difference of almost 900K. 900K. A 70K deposit every year will get you at the end of 30 years a fee difference of over 1.2 million. A 100K deposit every year will get you at the end of 30 years a fee difference of over 1.7 million. Mama, don't lie. Now let me summarize all these charts for you. I will take all yellow lines from each chart and plot them on a separate new chart so we can look at them side by side. Remember that these represent the difference that you pay due to the higher fee on an actively managed fund. This does not include the fact that you may pick a worse performing fund than the market or a better one. The blue line is the fee that you pay when you invest 10K per year. And the orange line at the top is the fee that you pay when you invest 100K per year. So we have min and max bounds for our fee amounts depending on where you fall in your investing amount. If you invest 10K, after 10 years you paid $8,300 in fees. But if you invest 100K, you pay $83,000. So what do you notice? If you save 100K per year, the fee that you pay is 10 times larger than what you pay for a 10 times smaller regular deposit of 10K per year. This makes sense, but you probably missed it when we looked at the other charts. So now we have a range, and we can extrapolate or interpolate for any deposit amounts without having to draw new charts. Very nice. So now that you know that your intuition doesn't work well for exponential growth, know that you're not alone. Humans are bad at predicting non-linear growth. Now, equipped with this knowledge, let's pick some ETFs. The first thing I do is decide what sector I want to put my money in. Let's say something that tracks the S&P. I have a spreadsheet that updates automatically where I can look at several ETFs in the same sector and sort by the expense ratio. Here we are. You can see the most expensive one is at the top, and as we go down it gets cheaper and cheaper. We can do it the other way around too, and now we have it sorted from the cheapest to the most expensive one. So the cheapest one here is VTI with a MER of 0.03%. Then I look at yields, and I can sort from the cheapest yield to the most expensive one, and you can see here the list of yields. I usually look for something between 2 to 4%. I stay away from ETFs with yields over 5%. I also look at their respective charts because I don't want to sacrifice growth for yield because I'm not retired yet. But as I get older and start relying more and more on my portfolio, I will rebalance into higher yielding ETFs and less growth. Now you can also look at ratings for each ETF, and Morningstar provides those. I don't do this because in 2007 rating agencies were caught lying and colluding with the banks. I'm not saying Morningstar is doing it, I'm saying it could happen again. So don't just buy something because the rating is good. That's a good start, but you need to research more. You can see some stats on the fund's profile page. For example, here's VTI on the Vanguard page. You can see the expense ratio is 0.03%, as you already saw from the spreadsheet. Again, I don't look at this. The risk potential, this is something someone else decided, not me. At the bottom, you have top 10 holdings. This shows me what the highest weights in the ETFs are and which direction the fund will go. Other times, I have my own opinions about some of the stocks in the index and take action.
For example, if I buy the S&P 500 and this has a 4.9% allocation to Apple,
and I think Apple is going down, so I want to hedge my exposure to it by additionally shorting an equivalent amount of Apple stock,
that comes out to 4.9% of the money I invested into SPY. Some options for me here are to sell some call spreads in Apple, buy some puts, or if I'm not in a retirement account, short the stock, if the stock can be borrowed. This is a little bit more advanced, so it went over your head, don't worry about it yet. Another thing I need to be careful about is my exposure. Let's say I already own shares of SPY and I want to buy more shares of something called VTI. What's my total exposure to various stocks? I own both SPY and VTI. This is because both SPY and VTI have some holdings in common. VTI holds 3.7% Apple and SPY holds 4.9% Apple. Maybe I think my exposure to Apple is again too high and I want to lower it. So again, I short Apple. Another example why I look at holdings is diversification. For example, a fund that holds 50% long-term bonds and 50% equities has gone up almost every year without me having to do any rebalancing. In comparison, a fund that is 50% financials and 50% oil and gas companies will crash badly when oil goes under, because oil companies get loans from banks. When oil drops, they can't pay back their loans to banks, which in turn makes the banks look bad. So this is not a well-balanced ETF. Oh, I forgot to tell you that the way I made the spreadsheet was by searching for funds first on websites like Fidelity or Vanguard. I'm not endorsing them or anything. I'm just saying you can go on those websites. So you find a bunch of funds that you like, and then you want to compare them. And the way you compare them is there's this tool created by FINRA, and I'm going to show you how to use it. After you compare them, you can keep the ones that you like and put them in your spreadsheet. And that way you can keep track of them, and then later on when you have money or you want to figure out, oh, I feel like deploying some capital today, which funds should I go to? You can just pick from your spreadsheet. I'll put the link to the tool in the description
below.
So now let's go compare a couple of funds.
Here's the FINRA tool I told you about. At the top you can see the three funds: SPY, the spiders, VTI, and VTSAX. You can see that the SPY is the most expensive, then VTSAX and VTI is the cheapest. Let's scroll down and look at the fees. So what I see here is that the MER for the SPY is 0.09%. That's why it has the highest fee. And the cheapest one is VTI, 0.03. Further down you can see where the funds fall with respect to other funds in terms of their fees. You can see they're all pretty much at the bottom because they track the broad market. And if you scroll down to rating, you see that all of them are 3 stars. Here you see the minimum purchase for VTSAX is $3,000, and that's because this is not an ETF. This is the only one that's a mutual fund. The other 2 are ETFs.
If you have a 401k account where your company does matching, you probably can buy whatever ETFs you want. The next best thing is to find out what the index funds that your company provides. And there's a trick to that. Index funds usually have the word index in the fund name, or IDX. Let me show you what I currently own in one of my retirement accounts. About 50% large caps, 20% mid caps, 10% small caps, 10% international, and a little bit of bonds.
You can see that I need to rebalance this portfolio because the percentages have moved. I will show you how you do that in another video, but notice that everything is an index denoted by the word IDX or index in the fund name, except for the JP Morgan fund, but that's just 1% of the portfolio, so it doesn't really matter. Now let me show you a different view of this. Here we can see the name of the funds, their ticker symbol, and performance data. Daily quote shows price at the end of the day, their NAV basically, you can see in this column. But let's take a look at the fees. The large cap fee here is 0.015%. Compare that to the fee for this other fund here right underneath Pioneer. That's 0.66%. Same thing for the bonds index, 0.025%. Where you compare this to the JP Morgan fund, that's 0.45%. Way bigger. And these are all in one of my Fidelity accounts. Some other index funds and ETFs to look at: VTSAX, or its ETF equivalent VTI, SPY, which is the S&P 500 index, QQQ or XLK, which is technology, TLT or the 20-year Treasury bond, BND, which is more bonds. For Canadians, we have the S&P in Canadian dollars, XUU, XIC or ZCN is the Canadian market, XDIV is for quality Canadian dividend stocks, XAW is world market, VAB is aggregate bond index, XQQQ is the NASDAQ in Canadian dollars. These are just a few options. I'm not saying I'm investing in these. I'm not endorsing these. They're just examples. I may own some of these in some of my retirement accounts. You may have guessed it by now that you can mirror an index or any type of fund by buying the exact percentages of its constituents. For most people, that's too many stocks to keep track of. So what you can do is approximate the index by buying the largest weights in that index, say the top 10 or 20 companies in it. And now you can save on a 0.04% management fee. Let's play this game first. How much money do you think you'd be saving in fees if you made your own ETF, instead of buying an index that has an MER of 0.04%? Let's just go to this exercise for fun. See if you got any better with exponential growth. Now let's look at the numbers. So here I plotted the upper lower boundaries for 10K and 100K yearly deposits. If you deposit 10K every year, it may be worth buying the index because in 30 years, you lose a bit over 8K. Or if you look at the average, it's around $270 per year. As you start depositing more, then that fee quickly jumps by the same multiple. The correlation is 1, meaning perfect. There's one more thing I want to talk to you about before closing. What do you think happens to a fund when a company's market cap grows? I mentioned that each company in the index is weighted by its market cap, or some other formula. That means that an algorithm calculates every couple of months or once a year how many shares of each company it needs to buy or sell to maintain the correct percentage weights. I will show you how to balance your fund in another video. Some of you are just sleeping on this stuff and missing out on opportunities. Stop being lazy. Learn how to invest today so you can have a better life. Like and subscribe to get more investing education. Ciao.